Aylwin Bay with Time Lord. We've already done a detailed look at May and dividend fishing with Miles Anderson and Miles Investing, but we're now going to do a quick summary of May. So, Miles, what was the top performer in May 2018?
It came right at the beginning of the month, you know.
Okay.
It was Mondi.
Monday. What did they do?
Mondi delivered for us a dividend yield of 6.1 in the end.
Yeah.
It was, in fact, this one was promising a smaller yield.
Right, okay.
But the share price clearly fell and the yield went up.
Yeah.
6.1% yield and 81.8%
Wow.
derivative
Yeah, I
yield.
think you said that to me before.
And
How you got that figure? 81%.
And it took 13 days to get your money back.
Wow. So you got your money back, 81% and 6.1%.
6.1%
Okay, so that was a good
dividend
performer.
yield.
Yeah. So, is that typical?
No. That's top end. You can get ones better than that, but 80% is pretty good.
Okay.
We typically normally look at around 20% range.
Yeah, that's
20%
your bar, isn't it? We've
that's
said
my
that
bar.
before, yeah.
Anything above 20%, we will do the deep analysis on it. And so, but 80% is like, it's kind of special.
Okay.
And it turned out to be the very best for me. So.
And what was at the bottom?
Okay. At the bottom was a household name.
Which is?
Tesco.
Oh dear.
Tesco. Now, disclaimer here, I'm not saying Tesco is a rubbish organisation and you shouldn't go buy baked beans there. I'm not saying that. I'm just saying when it comes to dividend fishing strategy, it's not one on our radar. They deliver a 10% yield, derivative yield, and they delivered a 0.8% dividend yield.
So if we look at Monday, 81% and 10%. Is a big difference, a huge difference, and your bar is 20%.
And what was interesting about the Tesco one, that came in a week when there was three companies that week it came out, and none of those three companies hit our criteria, and so that week we basically took a vacation. We didn't trade.
Okay, so this shows the level of risk as well between of the whole of the stock market, and you're concentrating on the FTSE 100, top 100 shares. So this shows you the risk, though. But what people must realise, though, is everything has a risk to it.
That's true.
So, I mean, I was a financial advisor, and people used to say, oh, well, you can't lose your money, can you? Investing in a fund or stock shares, ISA or whatever. I said, no, you can. But you can even lose money on putting money in a bank or building society, because obviously if you put money in a bank or building society, they lend that money out to get some money back in. They give you part of that interest rate on loans and mortgages and so on. But the amount you get back is below the rate of inflation. So you're actually losing out in real terms with inflation here, your interest rate here. You're actually losing out, in a sense, on your investment when it's in a bank and building society. So everything has a risk. People used to say to me, invest in a property. It's surefire guarantee. No, we've seen properties collapse and then regenerate and go back up in price. Nothing is cast iron guaranteed risk, is it?
When I was first looking at property in the late 1980s, 88, 89, the property price was relatively high. And I thought to myself, and everyone's saying, you've got to get into property, And I thought, no, I don't think so. It's at top of the cycle. I know it's coming. And what happens? It dropped down.
Yeah.
And by about 93, 94, it was at the bottom of the cycle. And guess what I did?
Invested in property.
I went shopping for property.
Yeah.
Because I basically bought the bottom of the cycle. But everyone who jumped in at 89 had negative equity.
Yeah.
And they had tears in their eyes.
Yeah.
Metaphorically speaking, they had tears in their eyes. And I went shopping and I had a great old time. Because guess what? By 97, when the price started to move up again, I was selling an asset class that was making money all day long.
Yes. And so that's what you need to do. I mean, you met the old adage there of buy when everyone's selling, sell when everyone's buying. Now, that isn't quite true of, obviously, dividend fishing, but on the property, that's the criteria that you met. You actually bought it when it was at the bottom.
Yeah, but here's the thing as well. I mean, if you're really going to be intelligent, you need to understand the cycles.
Correct.
Because all asset classes follow a cycle of sort. Now, the property game is a 20, 25-year cycle. It does this, and it's kind of waving up. Now, it's kind of trending up each time, but it's still in a cycle. And if you understand where the cycle is, then you jump in at the low end, and when it's right at the top of the cycle, maybe let someone else hold the property for you. Sell it to someone else and wait or put money to another asset class. The share market is the same, The stock market has another cycle. And it's basically a 7 to 8 year business cycle,
Right.
where you have 6 years continuous climbing. We call it a bull market, continuous climbing, and then for 2 years, 1.5 years, it drops,
Yep.
and that's called a bear market.
Yeah.
And what happens next? 6 years, 2 years,
Yeah.
6 years, 2 years, and so that's not exactly like I
Yeah,
said.
yeah.
But the point is, it goes through the cycles. So if you know where you are in the cycle, same thing again.
You can make the relevant response.
Yes. In other words, if you're in a bull market, go long.
Yeah.
If you basically buy
Going up.
to go up, and if you are in a bear market,
Go short.
either leave it alone or go short.
Yeah. I think that's the key as well, actually. Not only go short, because a lot of people, well, some people, they actually always want to make money, and this is about the greed. So even if it's going down, they'll actually still buy instead of leave it alone. And sometimes that, I assume, is based upon your knowledge, expertise, skill set, etc., as to whether you go short or whether you leave it alone. Now, some people have knowledge and presumably where they can actually go short for a longer period of time, whatever, they could be in that situation and they could do trades when it's short, whereas other people, some of your investors, subscribers, they should perhaps think about, well, I'm just going to leave it alone this week or whatever.
There are times when we absolutely say,
Don't touch
take
it.
a break.
Yeah.
Go and take a dividend fishing holiday.
Brilliant, because I love fishing. I love going on holiday fishing in France, there's big carp. Okay, so, and you can see in the background on all our videos, got some fishing gear as well, just to put a quirky twist on my Time Lord ventures. But anyway, that's May summary and a bit more. Sometimes we go off on tangents and chat about things, which is really good. But keep on watching, keep on subscribing, get in touch with Miles to subscribe to his dividend fishing strategy. Thank you very much.